If you own Tesla stocks, then it might be a difficult period for you. Elon Musk's electric car maker has hit a rocky financial period. Tesla shares have fallen to their lowest in over 2 years. They are 73% down than in November 2021. And it's only natural to attribute this decline to Musk's purchase of Twitter. Companies have long had to manage what's called the key person risk. They have even taken out insurance to deal with the top executives' deaths. But Tesla's plummeting share price and the chaos at Twitter uncovered a new kind of danger. The situation suggests that key people themselves can lead to the downfall of the company. Call it Napoleonic founder risk. And why is that? Because throughout his life, Napoleon's actions served as the perfect example of what not to do when it comes to risks. He lost his ability to manage threats and could not weigh threats and opportunities to come up with a solution. And something similar is happening with Elon Musk. Initially, you see, he came across as someone Gen Z would look up to, stirring controversies with his memes and tweets. But lately, his erratic behavior has got a little out of hand, especially since his Twitter takeover. Musk's bizarre Twitter polls have been hitting headlines. You remember most recently he asked users if he should step down as the CEO. Now that doesn't quite sound like a responsible CEO's behavior, does it? He made big claims that he will abide by the results of that poll, but when the majority voted for him to step down as the Twitter CEO, he said there wasn't any possible successor of the company. Twitter polls are straw polls, meaning they are informal and cannot be compared to professional public opinion research. Malicious bots or inauthentic accounts may also be able to register a response. Does it make any sense to base such high-level decisions on a poll? And that's just one example. In his short tenure, that in fact, he has implemented and often reversed a host of new policies. For the last couple of weeks, we have all been waking up to headlines of these policies. All this has led investors to be concerned that Twitter is taking much of Musk's time. Perhaps investors and lenders should be demanding a premium, some insurance of sorts that covers the risks posed by a star entrepreneur as he burns money along the way. In fact, Musk is already facing a lawsuit over his alleged failure to focus on Tesla due to outside ventures. And why not? Only a year ago, Tesla was thriving at its peak. It had a $1 trillion valuation. The car maker was worth more than the world's 12 largest automakers combined. Even though it had only a fraction of their sales, but that is not the case anymore. It's now worth only $399 billion. Almost $720 billion vanished from Tesla's stock market capitalization. The company bets on one man, and that man seems to be all over the place. He seems to be hurting the businesses that he is fronting, and this includes Twitter as well. The social media platform's shares fell by 5% when Musk took over. Banking on one person comes with huge risks. And there's nothing new about this. Business history is full of executives going rogue with corporate funds, of successful entrepreneurs who fail to realize that publicly traded companies are not their personal playthings. But it seems like old lessons must be relearned with each business cycle. And Meta is a case in point here. The company has a dual-class share structure. In this structure, a company offers two classes of stock. The class with limited voting power is offered to the public, and the other one, which has significantly more voting power, remains with the company executives and founders. Mark Zuckerberg holds only 13% of all shares, but he owns around 55% of the voting shares, and this gives him the trump card in all of the company decisions. In good times, this structure may have made sense, but with Meta's dipping share prices, it does not. Zuckerberg is betting away the company he is investing billions in, creating a virtual reality experience. Metaverse and investors are now up in arms. even though they have only themselves to blame. Now the question is, will Musk's lenders and investors heed this lesson? Even Tesla's worst year has not quite shaken the investors' faith. Retail traders have continued piling into the shares, while Musk himself sold Tesla holdings worth billions of dollars only to finance the Twitter takeover. He is preoccupied with the social media platform, yet it hasn't been enough to sour Tesla's die-hard fans. Musk's behavior so far suggests that only those involved are in for a costly education, even though they don't quite see it right now. WION now available in your country. Download the app now. Get all the news on the move.